There we go.
All right, we're good to go. Good morning, everyone. Happy Thursday, and welcome back to the We Wish You Wealth podcast. Happy New Year. We hope everyone's new year is off to a beautiful start. You're happy, you're healthy, and the abundance is flowing to you from the universe, as always. You have me, myself, Dani. We have Mr. Gordon.Chavez. And as you can see, back again, we have our loved and cherished tax advisor, Pamela Ferguson, joining us from Texas. How are you today, Pam?
I'm doing very well. Thank you for asking.
Thank you so much for joining us. We're excited about today. As we had discussed last month, tax season was approaching. Now it is upon us. Our favorite Uncle Sam is in town, and we just can't wait to spend time with him and, have either pay him money or have him pay us some money. I don't know.
Right.
Hopefully the latter. Excuse me.
Right. He is here and ready to collect.
Yes, he is. So, based on that fact, people are filing individual taxes, businesses are filing business taxes. So what we have today is, just a rundown of the differences of potentially what you need to do, how different things affect the way that you file your taxes. And Pam is going to bless us with all of her amazing knowledge in order for us to potentially utilize these tips to our advantage in order to maximize our refunds in 2024. So, with that being said, I do believe that we have a few questions laid out already. I believe we will begin with the individual tax portion and segue into the business.
Mhm.
Um, so let's see, where do we begin? Mr. Gordon-Chavez, what do you got for us?
Hey, Pam.
Hi, Gordon.
Thank you so much for joining us, Pam. Thank you for taking time out of your day to share your knowledge, your education with us. I don't think people realize how important it is that you do your taxes, you do them right, and you don't give away more money than you have to. That has to do with doing them right and working with somebody like yourself that can help you do that. So I have one that, and this one actually, thinking about it, I'm actually going through, and I say stuff, and I don't necessarily mean it in a negative way, but I'm taking on new challenges and things like that. And so the question is, how do life changes affect the way you file your taxes?
Life changes. That's something that happens every day, with between our peers, our family members. So that's a very important question that most people don't connect taxes to until it's time to file the taxes, and you're like, oh my goodness, I didn't realize I will be affected in that way. So one of the biggest ways or life change is marriage and divorce. Many people get married and they think that they continue to file like they've been filing in the past. And I always have to have that conversation that no, things change. When you get married, now you have an option to file married filing joint or married filing separate. You cannot file single or head of household like you've done in the past. So understanding the difference between filing statuses is a major issue amongst clients who are not familiar with their lifestyle and how it affects things. So marriage and divorce is a huge one. Having children, this one people know because they understand that, okay, I got a kid, now I get these credits out here. So that's a big one. So having children, adopting, things like that is a huge effect on how your taxes are filed and what your refunds could possibly look like, or even lowering those tax liabilities. And another big one is starting a business. When you start a business, that's major, and that's definitely a reason to reach out to a tax advisor to say, hey, this is what I got planned. This is what how things look. how should I proceed? How is this going to affect my taxes? So those are probably the four that I would pull right off the top, as far as life changes that would affect an individual.
Hmm. Yeah, thank you. Yeah. Yeah, one of the ones that I was thinking was purchasing a home. That's something as well, right? Because you get to claim the interest or something like that.
That is true. But you're right. Purchasing a home is a life change that will affect your taxes or could affect your taxes because they, of course, push the benefits of purchasing that home, which is you're looking at deducting that interest and the taxes that you pay on the house. But here's the kicker.
Mhm.
Our standard deduction increases every year. And the reason why our standard deduction increases annually is because that's their way of saying this is your cost of living increase. So a lot of people look for that from their jobs, but actually it's built into your tax return. So that standard deduction increase, and what happens for most people, but not all, is they don't have enough that have been paid out for interest and taxes to even affect the tax return. So although that is a life change for many people, buying a house is a big commitment and a big deal. However, most times they don't really see that benefit on the tax return.
Hmm. Okay. Well, thank you so much for sharing.
You're
Oh,
welcome.
yeah, thank you, Pam. Um, I got a lot to think about. No,
Mm.
as always. Um, let's see. So we actually, based on the fact you guys were just talking about home, a lot of people put their mortgage or their home into a family trust. Um, does having a trust or a family bank affect the way that you file your taxes?
Absolutely. So here's the thing. Trusts are like a big thing right now. And people are excited about it. I think the excitement is that people are starting to learn things or hear these buzzwords that are starting to become eye openers for many of us. But what is not talked about is the trust return, which is a 1041. Our individual returns are 1040, and the trust is 1041. So a trust is actually going to has a higher tax rate than your individual return. So when people talk about trust and they get excited and talk about transferring all these things over, they really do have to keep in mind that anything over 600 in revenue to that trust requires a trust to file a tax return, and the revenue in that trust is going to be taxed higher than it would be you individually. Now, when you're talking about a family bank, um, oh, and for the trust, there's a non-resident, for the non-resident alien, that's a status that people could carry. That trust is required whether it makes $600 or not. So you definitely, when you're thinking about putting together a trust or starting a trust, you definitely want to make sure you got the right people on your team to get that to get that started. And that's where you're going to be looking at attorneys to assist you with that. But going into the family bank, believe it or not, these are two totally different things, but they're always talked about in the same conversation. So in the family bank, I have a different concept when I talk about family banks, and we talk about cash spelled with a K, ASH with the acronyms, and cash stands for knowledge, attitude, skills, and habits. So when you're talking about that family bank, what you want to do is really focus on having the knowledge and allowing your children or your family to be able to pass down that knowledge, to be able to pass down the attitude about money, uh, money liabilities, as a whole, to be able to pass that knowledge down, the attitude about it down, the skills that you've learned around money, pass that down, and the habits that you've created or working on creating, be able to pass that down. That's a complete picture of a family bank. All right. So in your family bank, there's going to be, well, in a family bank, a lot of times in that conversation, you'll hear people say, the beneficiary is the trust, but that's not a requirement. You don't have to do that. So there's
Right.
ways that you can form that family bank without that trust, because your trust is actually um, protecting, it's a protective measure. And then the family bank is where you have components like the human assets of it, the financial assets of it, and then the intellectual assets of it. So family banks and trust is a huge conversation that really should be taken bit by bit, with the individual, the attorney, the tax advisor, the insurance agent, everybody in the picture. And so everybody should understand what the goal is in order to properly structure those things.
Right.
I try
Yeah.
to answer that without confusing people.
You killed it. I love
Yeah.
your words that you use for your acronym for cash with a K. A lot of us, growing up, especially including myself, we've discussed it before, weren't introduced to financial education. So, if and when that, I hope that more people start incorporating these conversations with their children younger. We start, bridging that gap, building that generational wealth, and like you said, adjusting the habits that we were trained to have in order to, have our families now reach new
Yes.
levels.
And
And
a good overview and example of that family bank is when you've put everything in place and that person passes away, because it includes an insurance product.
Mhm.
For example, you could say, well, 20%, we will take 20% of that with what they issue for the death benefit and go and place it on another individual in the family so that you can keep it going, keep the wealth transfer going. So, a lot of times that's the part that's the part where the ball is dropped.
Right.
The person passes away, the family receives the money, and so that's where cash kicks in, because without that knowledge, without the attitude, the skills, and the habit, you don't understand why we're taking this 20% out to place it on another family member. Well, because we want to keep the wealth going.
Correct. Yep. Yes. 100% agree with that statement. Dang. Lot of value in that. Thank you. Thank you for answering that. Let's see.
Yeah, I really like how like comprehensive and holistic your perspective is on the family bank, because you said it earlier regarding what was it, trusts, how it's like these what did you say, these oh man, I forgot the term that you said, but basically it's almost trendy, right? These words just start gaining
The
popularity online.
buzzword. Yeah.
Buzzword, exactly. And so it's like you hear it and and everybody's got a perspective, everybody's got an opinion, everybody's got, and I don't necessarily mean that in a negative way. I'm sure a lot of the folks that are on there, they know what they're talking about, right? But
Mhm.
in general, if you're in the audience listening and you're like, I'm trying to get my finances in order, I'm trying to take care of my family, I'm trying to make sure my kid's future is stable or taken care of or whatever, right?
Mhm.
And you're getting all this information because there's so much information online, right?
Mhm.
And so I really appreciate the way that you look at it and the way that you understand that trust is one thing, right? That's a legal, say, document, legal strategy, whatever you want to call it. And a family bank is a very different thing. And some people, when they talk about family banks, they're doing it in a way where they're saying they're describing it one way, and then
Mhm.
the way you described it, I really like that. It was really about knowledge, education, a unity of vision in a
Mhm.
family. Like, for example, me and my wife, we have four boys, and to get six people on the same page and understanding a concept the same way so that we're all in sync, that can be a challenge, And then, like, our kids are growing up. My oldest is 23 and he's already, he started his own life. And so, I really appreciate the way you described that. You had said something about $600.
Mhm.
And that when a trust, if I understood correctly, when a trust earns $600, is that per year, per month,
Per year.
per year?
Yeah,
Okay, so just about anything, if it's earning money, it's probably going to hit that 600 mark. And now it needs to, the trust as an entity needs to file taxes in addition to your own personal taxes.
exactly.
Okay,
Yeah.
cool. Yeah, thank you so much. I learned a lot on that question. Thanks for asking that, Dani. That was a good one.
It was. But I want people to understand too that in that example or explanation I provided, it doesn't mean that that the trust is incorrect. It just means that each of us have our own goals and we need to have something that's catered to our families.
Yeah, yeah. And part of that means working with somebody that really understands it so that they're not just giving you one cookie cutter strategy that they
Exactly.
offer everybody. Yeah. That's awesome. That's
Yeah.
awesome.
Let's see. What you got? What you got, G? You got any?
Yeah,
After
what
that,
you got?
I'm like, dang.
I know, right?
I feel
How
like
do
that
we
was enough for an episode.
how do we follow that? No, so
No.
this one's maybe a little more simple, right? And so you mentioned earlier that things change with your taxes. And so how often would you recommend people reviewing their taxes to make sure that everything's good and current and all of that?
Well, at least twice a year. So every 6 months, an individual can use, I refer this, the IRS site out called Paycheck Checkup on the IRS site. You can simply put that in Google and it will bring up the site directly from the IRS that will allow you to use your most recent pay stub and it will guide you through it. And that's how I show my clients how they can stay on track and they don't get surprised at the end of the year. So if you, at minimum, you can do it. If you choose to do it once a year, I would say do it in October. You know, that last quarter, see where you are. If you're right on track, that website, if you've entered the information properly, it will tell you. If you are way behind, it's going to let you know. It's going to even kick out a W-4 to turn into your employer. So if you're a real stickler and you're on top of things, you're probably going to do it every quarter. If you're a real planner and you're strategizing every quarter, you're on top of it. And that will be beneficial too, because it opens up opportunities for yourself to be able to do something with your money um, that could possibly help you earn more money, if that makes sense. Because if we're waiting till the end of the year, if we're waiting till fourth quarter, you're kind of limiting yourself. But imagine knowing each quarter if you're right on track. So that way you can adjust that W-4 and stop having so much money come out of your check where you can use that money to benefit you elsewhere rather than overpaying in taxes. And then at the end of the year, you've figured out in October, let's just say fourth quarter, you figured out, oh my goodness, I'm $2,000 over. So at that time, I would say go exempt for the remaining of that year because you're already overpaid, you know? But imagine had you known that from the beginning of the year, what could you have invested that money in? $2,000 is a lot of money.
Time to go shopping. No, I'm kidding.
That's
That is the thing you're not supposed to do.
what you don't
Right?
do.
I'm going on vacation.
That's a great tool. I actually just searched it up. I'm going to use that. I
Yeah,
like
it's
that.
really good. I love it. I love that tool. It's been a few years since it's been out. I don't know, time flies, so it could be longer than just a few years, but I definitely use it and I love it.
Yeah. And then with like tax laws changing and percentages changing, I'm sure that, I mean, it's straight through the IRS site. So it's probably the most current, most accurate.
Right from the
Uh,
horse's mouth.
There you go. I like that.
I like that.
Thank you
Yeah,
so much, Ben.
I'll have to check it out myself. Um, let's see. Based on, well, I obviously am learning a lot because I'm not a tax advisor. I'm a life insurance agent. Which brings me to my next question. Does life insurance affect your tax filing?
That's a really good question because people, probably the average person would say no. And that's true. It does not, but it will if you have received the interest from the earnings in that policy. So if someone chooses to get paid out over a period of time and it's earning interest, so they're receiving the payout plus the interest earned on that payout, then the interest is taxable, but not the death benefit itself.
Perfect. All
Yeah.
right. Interest is taxable. Good
Which
to
is
know.
why in IUL, for example, when people say, well, take a loan opposed to withdrawing your money, it's a taxable event because loans are never taxed,
Right.
ever. But when you're taking it out, that money has earned interest. So you've created a taxable event in the IRS eyes.
Okay. Understood. Understood. And is that so not with the loans, but is that so, could we relate that to like a lifetime income stream?
If it's paid out, depending on the product, and if it's paid out where there's interest earned, absolutely.
Okay.
Mhm.
Wow. Awesome.
Of course, you know, as an agent, how it's distributed makes the biggest difference.
Right.
Mhm.
Correct. So yeah, because you could take monthly, quarterly, semi-annual, annually. So all of that's gonna affect whether, that event, as you call it, is taxable or not.
Exactly. So it's kind of a hard question to say yes and no. It's got stipulations attached to it. But for the most part, if you just remember interest earned, it's going to always be taxable.
Understood. Understood. Well, I love life insurance. I love taxes now. I'm gonna move. I just moved to Hawaii. I'm gonna move to Texas and live with Pam.
You got an extra room,
You got
Pam.
an extra room.
There
Oh,
you go.
perfect.
You're all set, Dani.
When's the next flight?
Is that a taxable life event that we mentioned earlier?
Right?
I'll adopt her. I'll just play it.
Oh, that's funny.
Nice.
Oh,
I got a question for you, Pam. So earlier you mentioned, regarding that checkup tool and knowing whether you paid too much or you haven't paid enough. What are your thoughts on there seems to be a lot of hype on getting a big tax return, right? And what are your thoughts on getting a big tax return or tracking it and trying to get close to breaking even at the end of the year?
What I have to say on big tax returns is thumbs down. If you are, that's my biggest pet peeve. If you're getting a big tax return, especially if you're a business owner getting a big tax return, I feel like you've totally done it wrong and you've lost out on opportunities. And the reason why I say that is because as an individual, if you're getting a huge tax return, then to me, you've overpaid. You've allowed the IRS to have money tax-free. They don't, I mean, interest-free. And it's ridiculous. Would you loan your money out to someone just for them to return it in a year and you make nothing from it? What benefit do you get from that? As a business owner, if you're getting back refunds, that means that you simply was writing checks to the IRS and I mean for no reason. I can't imagine a reason someone would want to just keep sending checks just to get that same amount back. Now, if you're sending a check off to someone because you're earning interest off that money, great. But why send it off and you're not earning any interest? Makes absolutely no sense.
Yeah, I
So I'm
think
not a fan of refunds. I'm only a fan of refunds when it's a refundable credit, meaning that there's really no liability there, but they're giving you a credit because something like earned income tax credit, which those people are lower income individuals. And even those individuals should be very smart with how they're allowed allowing taxes to come out of your check. If you know you're going to get a big refund and you're a low income earner, then you should definitely be planning your money around those refunds that you know you're going to get that are pretty big. And it's easy to do, especially with Dani and Gordon here. They got some absolutely amazing strategies that could help an individual who's low income earner all the way to your high income earners and business owners. Everybody has a place when it comes to putting your money to work. It's almost like it's not almost like, it's exactly like hiring an employee. When you hire an employee, you hire that employee to earn your revenue in that business, right? So if that employee just sits there and not do the work, meaning you don't get the revenue you plan, and you pay them 10 an hour and they're not bringing in, doing their part, you're losing money. But if you put your money in the right place, you hire your money as your employee and you put $10 in and it's earning 15 an hour, that's a no-brainer.
Yeah.
Right.
Yeah. Put your money to work for you. Yeah.
Exactly.
Money work.
Yeah.
Yeah.
Thank you.
If we hire an employee and they don't do the work, we fire them. Same
Right.
thing with your money. If it's not earning money, you fire what you're doing with it.
Mm-hmm. Yeah. I
Yeah.
like that. I like the way you say that.
Yeah. And there's so many different strategies to make your money make money
Exactly.
and protect and keep it safe too.
That's huge.
And that's a really big thing that, a lot of people aren't educated about. We're talking about education, not having the knowledge. So if we can break even and, as you said, you don't like refunds, but learn if we're not getting a refund, or as you said, with the business, utilizing that $2,000 or whatever it was to invest it into other assets. That's huge then. And that could, whatever it is that you're investing in at that point, you know, you could invest in something that could get you a return that's higher than the tax refund that
Exactly.
were, that
Absolutely.
you were waiting to get.
I mean,
So,
the refund was already your money.
right. Right.
Yeah. I think for some folks, the concept of the fact that you're giving them money every time you get paid, part of your money is going to the government, so it's your money, and then at the end of the year you're just reconciling, you're just saying, okay, I gave them this much, I was only supposed to give them this much, so the government's going to, basically the government was like, we took more, so here's the difference.
Mhm.
It's not that they're giving you their money,
Right.
and
Right.
I think that's part of that concept, is that people aren't really paying attention to the fact that their money is going to the government. And then at the end of the year, the government just wants to make sure that the numbers are right. And if you
Mhm.
paid more, they'll give you some back. If you didn't pay enough, then
Give
you're
me
going
my
to end up
money.
having to pay them. Yeah, exactly. And they're not playing when it comes to their money.
Right. And
So,
another thing too, Gordon, is they absolutely believe that, but then there are some out there who overpay because they look at it as a savings for them,
yeah.
and they don't realize that there are just so many other places, even if it's not insurance, you got a high yielding savings account that you can put money into if an insurance product isn't working for you. So there are so many
Mhm.
other ways that you can put that money and it still be savings, where you just kind of gotta work on your discipline on not touching it, but it's very
Exactly.
doable. And that's going back to
Exactly.
cash, creating that habit.
Yeah.
The H from cash is creating habit and the skill to understand the whole thing: knowledge, attitude, habit, and skill.
Hmm.
It's, it applies to everything.
Yep.
Yeah. Very true.
I love it. I'm gonna write that on my mirror.
There you go. Cash.
Cash. Cash. Cash is king, baby. Can you guys hear my rooster over there?
Weird.
He's going off again. I was telling Gordon this morning, I was trying to record a video and you could just hear. So, speaking of pets, is it possible to write your pet off on your taxes, or my rooster or my dog?
No, It absolutely is. Just got to get creative. The only thing about the whole pet write-off thing, back in the day, people used to really try to put their pet on the tax return. Um, but now, we went all these years knowing that a pet is not a tax deduction. It was compared to their dependents. Pet isn't, it's your dependent, but it's not your dependent in the IRS eyes. However, if you are clever enough to be able to turn it into, there's three categories when you're talking about a pet. You can turn it into a business. You can you can turn it into a business, or you can use that pet in your business, or you can use it in medical or charitable type situations. So if you're using it in your business, you got people who use cats for pest control, dogs for security, advertising strategies. There's a lot of different ways that you can get really creative when you're using your pet, and you can turn that pet into a deduction. You just got to understand how to stay away from falling into the hobby category. So the way to do that is you want to be sure that it's clear that your intent is to be profitable. Okay. So if you're using it in your business, it has to make sense. If I use my Yorkie for advertisement, that advertisement better make sense. So if I take it with me to different trade shows, and there's some kind of way I can connect my Yorkie to me talking about whatever business I'm in, as long as it makes sense, that Yorkie becomes my tax deduction. If you're looking at turning it into a business, I have a Yorkie, and what if I just enjoy animals? It happens to be a hobby, but can I turn this hobby into a profit? I absolutely can. And then I decide I want to start breeding that Yorkie. So you become a breeder, and now you've made a business out of something you already love, is very profitable. Now you have tax deductions. Or then you maybe charitable. Maybe I need a service animal. And when it's a service animal, it's absolutely a tax deduction.
Perfect. My little, he's laying over there in the dirt. I am going to name my little Chihuahua Jack Russell mix my security guard.
See, you're a Chihuahua. I don't know, but some people have animals on their yard that they have to round up, and they use a dog to do it. I don't know if a Chihuahua could do it, but just imagine your little Chihuahua rounding up all the chickens. If it makes sense, there it is.
He doesn't bother them too much. He mostly just wants to chase the tennis ball. But I'm gonna find a job for him, and it's not gonna be a hobby. So I will be able to write him off. I'm gonna put him to work.
Hey, Dani, you're kind of young, but here in San Diego, and I don't remember where exactly, and it might have been some in LA too, but there's this guy called Cal Worthington. I don't know if you ever heard of or remember Cal Worthington.
I think so,
He owned a bunch of car dealerships.
Right.
And on his commercials, his tagline was Cal Worthington and his dog Spot. And so in his commercials, he's like a cowboy guy. He's got a suit on, his cowboy hat, and he would have different animals, bears and tigers and like chimpanzees, all in his commercial, just kind of being, just grabbing people's attention, right? Attention grabbers. So I could see Dani with a chicken in one hand, a rooster in one hand, and her Chihuahua in the other hand, talking about life insurance and cash values. And
literally, my wheels are turning.
There you go. See,
no joke. Like, I'm gonna make it happen.
See, it's possible, and even decor. People fish tanks.
Oh yeah,
that's decor.
Wow.
Yeah. You put a fish tank behind you when you're recording your marketing videos.
Exactly.
There you go.
Wow. I would have never thought of a fish tank.
That's why all you guys need to, in the audience, you got to call Pam, because she'll work that for you.
Yeah. She's making everybody's tax dreams come true this year.
Light bulbs going off right now.
Yeah, I love it. I love it. I guess we'll we'll go ahead and transition into we did individual. We did kind of touch base on some business aspects of taxes. But I think we've got some questions. Maybe other people also need these questions answered. I guess does a small business have the same tax benefits as bigger companies?
You know what? I think that a lot of people, when they start their sole proprietor, meaning that you just went out there and did a DBA and you're just doing business, they think that they don't have many deductions or write-off opportunities available to them. But when it comes to larger companies that we think, oh my goodness, they're big and they're this and they have a brand, they I don't have the same benefits that they do. And the truth is, you absolutely do. With exception of talking about, corporations or how companies are set up as far as their entities. But if you're just comparing yourself to, your own individual self versus someone out here who's maybe they have an LLC, but they're huge. Maybe they elected it as S Corp. For the most part, we all have the tax code applies to all of us. So you go and you pull the tax code, it's huge. There's no one person out there that knows all the tax codes. So the answer to that question is absolutely. In a general sense, if you're small or just starting out, as long as you just need to, when you start your business, you just need to make sure that a transaction is happening. Once that transaction happens, that means that business is in place. And when your business is in place, now you're open to the same tax deductions or tax codes as anybody else.
Right.
Mm. Nice.
That makes sense. I was unaware. I didn't know if maybe like potentially like how many employees affected that, or
That's when you get into structuring, and there are different opportunities that will come to those with employees. Yes. So maybe bigger companies will have more simply because how they're set up, but the basic deductions as far as running the business, it's still the same for both. But when you start employing people, then you're opening up other opportunities for deductions. So it may, one set of deductions may apply to one certain company because they do have employees. And I'm over here just self-employed with no employees, where of course I don't have all of those opportunities. But the moment I hire an employee, then I still have the opportunity. So technically, yes, it's what stage or phase you're in.
Okay. I thought you hired your Yorkie.
No, I could hire him.
Director of marketing for
Yeah. Oh man.
I could. He's not ready yet.
Oh, okay. This needs a little more training.
He's still in training. Yeah, exactly.
I may hire him on the advertising side. I do get a lot of likes on my posts when I post him opposed to me. So he may work out.
All right. Well, I hope it works out for you.
I just put a little note in his mouth and let him walk, and there it goes.
There you go.
That's perfect, man. We're gonna be throwing ideas off of each other.
Go
viral. Our group text is gonna be just ping, ping, ping. Oh my goodness. All right, back on track. What you got, G?
So I have a question. So you had talked about this. We did the other podcast regarding tax strategies and different things like that. And you talked about purchasing a vehicle for the tax benefits. What are your thoughts on that?
Well, I think it's overly advertised on social media because it's kind of putting that message out there to go purchase a G-Wagon. That's the name I couldn't think of.
That's the one you were talking about?
Yeah.
Those Mercedes, yeah.
Go purchase that G-Wagon, and everybody's eyes light up. And they're telling the truth, you know, it's real, but to do it just for the credit, I don't think it's smart because you're still taking on a liability. At the end of the day, and if it doesn't make sense for your business. So sometimes someone asked me, and I mentioned, I forgot what kind of business they were doing, but think about being if you had a business, okay, an insurance agent, but you're a virtual agent. You only do telesales, right? Meaning that in an insurance agent's industry, it's a no-brainer to drive to your client's house or place of business, right? But if you're a tele agent, you're in one place for at least 8 hours on the phone. So is there really a need for a vehicle?
Right.
So even if I'm earning the proper income and I say, you know what, I'm going to go purchase that G-Wagon because I can get a deductions. Well, if I'm using, especially if it's one vehicle, if I only own one vehicle and not two. So if I own this one vehicle, I go out and I go get this G-Wagon just for the tax credit. I don't even use it in my business.
Right.
I may use it to go pick up a few supplies, but the difference is if I had two vehicles I owned and I used one vehicle only for business. I don't care if I got a schedule of picking up supplies weekly. I have to go to the mailbox, to the post office so many times a week. Now I'm picking up some mileage, right? This is me having two vehicles. Then does it kind of make sense there? Yes, because I can honestly say, no, I use this vehicle for business 100% or 80% of the time, and I have my other vehicle available for my personal use. But if you have one vehicle and you're saying that you're telesales and this vehicle is for business, then I'm going to have to question that because why are you saying to me that this vehicle is 100% used for business? You don't have access to another vehicle for personal use and you work from home. You really don't move. So now I have a concern. So to answer your question on the vehicle, if you're in a business that requires a lot of travel for that business, it makes absolute sense. If you're in a business that you don't really drive a lot, it makes no sense. Not just to take the deduction.
Yeah. Yeah,
So,
I did a quick search right now on G-Wagons, and the average lease on a 2023 Mercedes-Benz G-Wagon is 2660 per month. That's more than I pay on my mortgage for my house.
That's
So
what I pay.
that
So
tax credit better be really good for me
it
to
will
be
be
driving around.
good. It will be good. It's very attractive, very attractive.
Wow.
And I am a fan of it. But the only problem is it's just not for everybody. And I think that's where the misconception is across social media.
Yeah, it's got to make sense.
Yeah.
so if you are a business owner but you only have one vehicle, but it's strictly used for your job, um, then would it be beneficial to utilize that? Because do you have to have two no matter what?
No, you can use so there's automobiles are really good are really good strategies because when you have one, you just have to keep good records because 100% it's either going to be, if it's 100% use, it's only going to be for business or personal. It can't be 100% for both. So you're going to have to break down the percentage used for business versus personal, and that's what goes on the return. If
Okay.
it's only one vehicle, now you're opening up different strategies because I may be able to take deductions that are depreciation, mileage, leasing, or whatever qualifies. You want to do, you want to compare them to see which avenue is going to be the best, the actual method or the other method for that vehicle. But when you have more than one, then you're opening up more opportunities to get better write-offs on that vehicle. But if you're
Okay.
dealing with just one vehicle, you definitely want to make sure that you're keeping those records across the board, whether you have one or more. But you want to know, what percentage am I using this vehicle for business? What percentage am I using for personal? So then that
Okay.
goes into those that do DoorDash, you know, Uber, all those things. Some of these people who do that have that's their personal vehicle and it's their company vehicle, right? So when they're looking at the reports from Uber or DoorDash, they're actually able to see that, okay, I drove 60 miles this year. This report shows 40 miles driven for Uber. So what does
Mhm.
that mean? You figure out your calculation on what percentage of this was business, what percentage of this is personal.
Okay.
Okay. You have two vehicles, you take that scenario, and sometimes you drive your vehicle, sometimes you drive that second vehicle. Why? Because you want to put yourself in position to get a bigger tax deduction versus using just one for just
Mhm.
one depreciation or mileage or whatever, whichever deduction fits your business situation.
Thank you.
It's a lot
Well,
that goes into that automobile.
yeah, yeah, it sounds like it. It's could be its own
Yeah.
episode.
And that's another thing too. It's so much that go into it that the piece that's being given across social media is leaving out all the additional things when it comes to it. So it's something that if you're going to look into it, you really do want to look at the comparison on how should I deduct this vehicle? Because depreciation isn't always the best.
Right. Okay, good to know. And based on, we're talking about deductions and all of that stuff. What if I can't pay my taxes? Should I still file them?
Yes. Yes, because you get punished for not paying, I mean, for not filing. So you definitely want to file it and figure out how you're going to pay it later. The IRS has plans you can get on. You could probably even be forgiven, depending on what your situation is. But at minimum, you want to make sure you get that tax return filed so that there's no way that they can come after you for not filing.
Right.
Not paying, that's something different. It could be worked out, but not filing, there's no working that out.
Okay. Pretty cut and dry. I like
Mhm.
it. That was
Yeah,
a simple one.
that's
I
probably
will.
the only thing cut and dry today, huh?
Right. Oh, oh boy. My brain's working in overload. I have so many things going on in there, just based on all of the education. I'm like, man, this
Ooh,
is this is too good. Too good. Thank you, Pam. Thank you.
welcome.
What you got, G?
Yeah, I have a question. So if I'm small, the question would be, do I still need a board of advisors or directors?
Yes, this is something that is overlooked across the board. People are so quick to go out and start an LLC, and they skip this step. This step is skipped 99% of the time, and it's because it's never really talked about. And so earlier we were talking about how, Gordon, you have your wife and I believe you said four sons, and we talked about the cash perspective, the acronym, and you mentioned how, it's really difficult to get everybody on the same page.
Mm,
Well, that's where your board of advisors come in when you're dealing with a business. And I'm speaking from a family perspective because, it kind of fits what we're talking about today with insurance agents and taxes and how the family is affected. So when you start your business, and let's just say you start an LLC, you want to name your family members as your board of advisors. Why?
mm,
Number one is asset protection. It's going to keep your business protected. For example, if someone sued you, if someone sued the company, and there's this thing that we refer to as minutes that are being kept.
mm,
Sometimes you could do annual minutes, but if you want to be more consistent, you could do monthly or quarterly minutes. But when you start an LLC and you're not keeping those minutes and you get sued, the fact that you don't have minutes could cause you to lose your LLC protection rights.
Mm.
So having a board of advisors helps you to put things like this in place. It makes you a better business owner. You're being more accountable. You're teaching your kids. You're teaching them how, back to cash. You're teaching them that, you're giving them that knowledge of a business. You're giving them that attitude behind money. They're understanding skills. They're picking up skills that they can use in their own businesses, in life, even on their jobs. And they're creating habits. You know, you meet monthly, quarterly, annually. It then becomes a habit. It's that family bank that we're talking about again. This is part of that family bank. And those habits that create is still a part of your wealth, meaning that this tradition now is going to be passed down, and it becomes, well, this is what we know. This isn't, it's almost second nature to them, and so they become better business people too. And it just overall, it also opens up tax deductions. So in addition to the assets that it will create as far as asset protection, in addition to being a better business owner, you now, when you take those trips, I think we talked about this on the last podcast, you now can go to Disney World, entertain the family, and have your board of advisors meeting right there and create an environment where you're able to write that entire trip off.
Yeah, I need to do a family business trip to Italy or something like that is what I need.
Now things are different. The rules kind of change when you go to a different country, but
Oh boy.
Oh man.
yeah, it kind of,
That's another podcast.
right.
I
But
would have never thought of that, but I guess it makes sense.
yeah, I mean, but you know, if you have an annual family trip that you get a chance to deduct, that's amazing.
Yeah. I'll be taking advantage of that.
Can invite Mickey and Goofy and Donald to your meeting, you know, right in the middle of Disney World.
Right.
It even opens up opportunities to pay your family member too. So if you're looking at hiring your child and you know you're paying that your children, they're on the board. So you can pay for being on the board.
Awesome.
I
Wow.
like that. Thank you.
It's all intertwined together. It's crazy how so much of it can go into just this one cohesive.
Exactly.
And you know, there's a lot of, like, you know, including myself, a lot of individuals that don't understand how to make all of this work together and flow to their advantage. So thank you, Pam.
You're welcome. What it boils down to is the money's going to be spent either way it go. It's just how am I going to spend it?
Right. Yep. Let's see. We were talking about working from home. That's what I do. I mean, granted, my office isn't that. I can't complain about that. You were talking about it snowing. Gordon's over there. I know it's cold in California. But what exactly is the home office tax deduction, and how can I apply it to my refund?
Well, home office, now the home office deduction it is really a huge deduction that's overlooked because a lot of people feel that it's a risky deduction to take. And there's a myth that if you take it, then your return, you're likely to be audited. Number one, if you're keeping good records, there's really no need to be concerned with an audit. So you know, it's like, okay, I got audited. Here you go. You know, if you keep good records, it's so what if I get audited? Secondly, I just want to kind of get rid of that thought process behind having a home office because you do, like you said, Dani, you work from home. So why not take the deduction that is given to you? It's in the tax code. It is applicable. Take the deduction. And so there's two there's two methods. There's a simple method and the simplified method and regular method. So
Okay.
when you want, so let's talk about individuals first. There are a lot of people who have W-2 jobs that work from home. And I get this question every single year. I work from home. Can I deduct my office? No, you cannot because you're an employee. So employees have absolutely no benefits when it comes to working from home. But the flip side to that is you can go to your employer and ask them, could they work out something where there's a reimbursement for working from home? So whether it be your internet reimbursement, your cell phone reimbursement, some type of reimbursement they can put into place. And when you get reimbursed, that is not taxable income. So anytime your employer reimburses you, that's just money that you're being paid back. It is not taxed on the tax return. It is not added to your income on the W-2 as taxable wages. As a self-employed or even a business owner that has an LLC with employees that maybe even turned it into S Corp, those people can take this home office deduction. Home office deduction is, sorry, it was a tongue twister. But when you're doing the home office deduction, the key is you don't want to get greedy and aggressive with it. Take what is owed to you and keep it moving. It's a big advantage on the tax return. I don't care how small your office is. Take the deduction. It's something, and it all adds up. If for those that have side gigs, whether it's a side gig or maybe I used to have my home office and then I had a physical office outside of my home. You still can deduct your home office, and it's making sure that your home office is where the administrative work is done. So now what you've done is you've created an opportunity to add in more deductions because you're working from two different offices. But one, you're saying, well, this is where I do my administrative work, and the other is where I'm meeting people.
Right.
For insurance agents, because sometimes you go and meet people, most times you're working from home. You can take this deduction and it wouldn't be a problem. And you'd be surprised at how huge. So imagine your personal vehicle, you're driving it to your job and you wasn't taking the home office deduction. You're driving it to your office every day. So what you can do is those trips back home to your administrative office or trips in between your day, you can turn about 3,000 miles into a deduction simply by having that home office that you've created as your administrative office. If you're an S Corp, the S Corp takes it off of their business return as a deduction, and then the S Corp that you own in turn reimburses you as the owner or employee of that company. So now what you've done is you've deducted it from the business income and you reimbursed it to yourself personally. So now you've created deduction and you got the money back tax-free. You turned it to tax-free. I don't want to say income, but it's tax-free reimbursement for you.
Yeah. Wow.
Is it a lizard or a gecko? Or you see it behind you, Dani? Oh,
No.
it went into the shed. It made its
Oh,
debut.
yeah, it's a gecko. They're everywhere. Yeah, they're fun.
Dani reporting live from the jungle.
Right.
It distracted me for a small second, but hey, but yeah, that home office deduction is a powerful deduction, and you can get very creative with it. You just don't want to get aggressive with it.
Right. And you said it has to be a separate room,
Separate room,
strictly
dedicated to your
utilized.
Yeah.
Yeah.
So you don't want to have, and you know what? It's a good idea if you have a home office because you never know what could happen. Take pictures. Take pictures of your office because if you're ever in an audit and maybe you moved or something, you want to be able to have those records to show that this was your home office. So another thing too with the home office, it doesn't have to be one room in the house. I could use a section of my garage for other things that I have to store, files or anything. I could use a different closet from the room that I'm in to store my books. that is part of my, what I need for my office. So all of those, you calculate the square footage of it all, the total, and that becomes part of your home office. So it could be separate. It could be your main office, the room you use. In addition to that, the extra spaces that you may be using as part of your home office for storage, possibly.
Awesome. Thank you so much for that.
You're welcome.
Let's see. Dang, we got good juicy details today. I'm liking it.
I feel like we went a little deeper today.
I'm still in the tea. All the tax tea. Well, I know that we had mentioned it maybe, and like may necessarily be, a topic for another discussion. But because some people file their taxes with tax software. Some people like to use a tax advisor. Do you think potentially that you have some time to meet with us again and discuss maybe the pros and cons, the benefits of both of those, whether they're strategic, not strategic, and what the differences are between the two and how they potentially could affect the refund that you get?
Yeah, absolutely. I love to share that because, the software, the professionals, there's a place for both. So I would love to come back and share my thoughts on what I feel about the softwares and the professional versus even the individual doing it themselves. I'd love to come back and share my thoughts on that.
Awesome. We would definitely appreciate it. Let's see. G, any other questions? My brain is in overload, yo.
No, I think we're good. I think that was a great episode. Again, Pam, I really appreciate you taking the time to jump on this with us and share more information. You know, maybe you can share, Pam, how people can reach out to you. What's the best way for people to reach out to you if they want help with their taxes, if they've got questions or whatever? Where can they find you? How can they reach out to you?
Thank you, Gordon. I enjoyed you all today. The best way to reach out will be to go to my calendar. That's calendly.com/Pajeco. That's spelled Pajako. Again, that's the best way to schedule 15 to 30 minutes with me to discuss whatever your situation is today. You can follow me on all platforms at Pamela at Pajeco. Again, that's spelled Pajako. I'm on Instagram. I'm on YouTube. I'm on Facebook, TikTok, and the X. Is it the X?
The X. You talking about your ex? What's this?
The X.
Formerly known as Twitter.
Formerly known as Twitter, but I'm across all platforms and put in Pajeco. You're probably only going to find me. I post a lot about different taxes, strategies, as well as insurance with my partners, Gordon and Dani.
Awesome.
And
Yes.
you're headquartered in Texas, but you can help anybody across the country, right?
Yes, I'm in Texas and I do service all states.
There you go. So
We
call
offer
Pam.
service for bookkeeping, taxes, strategies, payroll, anything dealing with. So overall, we are advisory, but what falls into that are the different types of services that are needed. Some people have books that have never been touched. Some people are up to date. And so we kind of have that conversation and figure out where you need us. And that's where we fall in place to assist you so that we can get to the main goal, which is lowering your tax liability.
There you
Awesome.
go.
Love it. I'll be sending plenty referrals to you.
I appreciate it.
As Gordon said, Pam, we thank you so much for your time. It's always a pleasure to have you here. Your education is a little overwhelming sometimes. But it's good to have these conversations, especially with the professionals such as yourself, to, get people thinking and start really learning as to how, like you said, to utilize these strategies to their advantage and lower their tax liability. So we thank you so much for your time. We will look forward to seeing you again here. Did we say the 25th?
We said the 25th. Yes.
Okay. So if you're listening, watching, we will be back January 25th. What time is it here? 9 a.m. Hawaii Standard Time, 11 a.m. Pacific Standard Time, and 1 p.m. Central Standard Time for another episode of We Wish You Well. We hope to see you guys next time and hope that you got as much value as we did. Have a great day, and we wish you well.
Bye.
W.
Awesome.
1 second, you guys.